What is needed? What sort of price is needed to incentivize investment?
We need, in our view, at today's prices, over $1,900 an ounce per platinum price. And that's in today's rand environment that we need as an incentive price to encourage producers to invest this large amount of capital that is required to maintain the long-term production of this industry.
And what will the industry do if the price remains at current levels?
Our concern is one of a long-term nature. People are making decisions now to spend capital over the next 5 years or so to bring production online in the next 5 to 10 years. If the price stays at today's prices in real terms over this period, I am absolutely convinced that this industry will see a disinvestment.
Do you see the shaving off of your capex as an indication of this disinvestment sentiment at the moment?
Our capital situation is in the context of Anglo American Platinum, which is slightly different from the rest of the industry. We have in Anglo American Platinum the opportunity to go after less capital intensive projects than what many of our colleagues in the industry are able to do. So in our case, it's more a matter of identifying real opportunities. The UG2 in Rustenburg is a real opportunity. The debottlenecking and the future expansion of Mogalakwena and Unki as a mine are real opportunities where we can spend less capital than most and still get the production results going forward. Our concerns are more along the lines of the industry. And if the industry falls apart, then we will not be able to stand in this industry on our own. My observations in terms of price are Southern African related, and underground mines, whether they're in Zimbabwe or in South Africa, face the same dilemma. I don't have a number in my head, but I am sure that the incentive price for investment in Zimbabwe is also over $1,900 an ounce.
And is it sentiment or fundamentals that are driving this downward movement of the price?
We believe that in the last while, up until about the middle of last year, we were a fundamental driven industry. You could see supply and demand, the balance would give you an indication as to whether the price would be where it is. I think in the last few months, maybe from the middle of last year, there's been a lot of sentiment in the market. We think that the current price is down on sentiment, and it's sentiment from the European sovereign debt crisis that is flowing over into our industry. It's not in the fundamentals, the fundamentals that we've been able to see. Our real concern is that if this sentiment continues and the fundamentals are not respected in our industry, it may damage our industry in the long term.